Continuing on in our series of I thought my property manager would handle everything, and it turns out I was totally lied to. Here's just one example of some of the things we do at Bedrock that people don't talk about as necessary, that they would love to have, but they have no way of getting, and just some of the value we try to provide to our clients. Because property managers do not handle everything, but passive real estate is a great asset class. And so you got to think to yourself, hey, I'd love to own some real estate, but I don't want it to manage my whole life. How do I do that? Here is a great example. This is an annual report. Bedrock manages hundreds of properties every single month all across the country. That's my biggest company. And we produce these reports for every single client on every single property every single year. Now, what's interesting about this report is it's a culmination of a lot of work. Right? And so think of it like a hamburger. This report is the burger and the lettuce and the tomatoes and the pickles and the ketchup and the mustard all put into one. So let's go through this and just kind of zoom in, zoom out and show you specific parts of this report and just walk you through a couple of the finer points of what a good annual report on a single family residential piece of real estate looks like. You can see our client has owned this property in Memphis for 4 years. They paid $50,000 for the property, and the original purchase price was $207,000. So their total property investment, all their fees, all their closing, all their points on their mortgage, everything, they only spent $54,000 to buy this house, but to control a $200,000 asset. That's one of the reasons that single-family residential is awesome. You can only put up 20% or 25% and control the entire asset. You get 100% of the appreciation, you get 100% of the rent, minus what you're paying to the mortgage, and in 30 years the thing pays itself off and you own the whole thing free and clear right in time for retirement. So their investment's $54,000. It was purchased for $207,000. Today, as of today, 4 years in, we pulled some data every single year just to get an idea. Now, what we decided to do with Bedrock is we weren't going to go and do a CMA, reach out to the market and have the realtor actually run and do the numbers. That would cost us about $200 a year, and we don't really need that. We need the simplest view. So what we use is we use a combination of Zillow, Trulia, and Redfin. We just take those three numbers once a year, we see where they roughly are, we average them out, and that's our estimated value at the end of the year. That's a pretty decent way to say, okay, it's probably somewhere around there. Yeah, we know it's not going to be 100% accurate. If you're freaking out in the comments, stop. You're freaking out in the comments. And so with that being the case, yeah, Zillow, Trulia, Redfin, we look at that, we take the average. So at this point, the client's owned it for 4 years, which means about $260,000 up from $207,000. We take every single return and we math it out for our clients. And you can see right here, almost $14,000 of appreciation averaged per year. We don't know which year was more, which years was less. No one really cares. Off of a $54,000 investment means this property picked up almost 25% of its return on investment in this single calendar year. That's freaking awesome. That destroys any annuity out there. That destroys most mutual fund accounts or index funds. 25% is freaking amazing. Plus, the reason we were able to get such a good return is because we leveraged the asset and we were able to have 80% of the bank's money at risk. That's freaking awesome. Beyond that, we're able to have all these other burger pieces. The hamburger, right? The hamburger, and then the lettuce, and the tomatoes, and then the pickles, and ketchup, and mayonnaise. Single-family residential is a burger asset. It's all these little pieces that add up. For example, the IRS says that this house is going to wear out. All right? It's like the ship of Theseus, right? At some point, every piece of that house is going to wear out. At some point, you're going to need a new roof. At some point, you're going to need a new garage door. At some point, you're going to need to get in behind the brick and replace it. Now, what the IRS says is we're going to say the whole house is going to wear out in 27.5 years. So every 27.5 years, you can write off the entire value of your property. So every year, you can write off 1/27.5 of the value of the depreciable amount. Now, that's not the whole amount. What a CPA is going to tell you, or at least what they told me, is that represents 80% of your purchase price. I'm not a CPA. I don't even play one on TV. All right, talk to your CPA. This is not financial advice. As you can tell from the tone, tenor, and candor, this is entertainment. This is just entertainment from a guy who happens to have done a absolute crap ton of this. So with that being the case, 80% of the purchase price. So let's pull out the old handy dandy calculator. Let's do the old Bob Ross, right? You pull out the old handy dandy calculator and you say $207,000 times 0.8. What that's going to give us is the depreciable amount. Now, that's important because what the IRS is going to say is, hey, you bought the property for $207,000. We know that it's all going to wear out, that it's all going to get replaced. You're going to end up buying a new water heater, buying a new garage door opener, buying a new garage door, redoing the brick, redoing the siding, redoing the roof, redoing the cladding, whatever the crap, right? Eventually, all of it must go. It's all going to get replaced. Except the land. Land doesn't depreciate. That's a very, very important understanding. Land doesn't depreciate. So they won't let you write off the full 207 grand. What they're going to say is, hey, you can write off 80%. You can write off the house and we'll assume 20% is the land. That's what my CPA told me. I think that is standard common practice. Talk to your CPA if you have any questions. If you're a CPA and that's not exactly how it is, feel free to comment and like and subscribe. Because I love CPAs. Let's do this thing. All right. So with that being the case, you've got 80%. So you say 207 grand times 80%. Bam, $165,000. So my depreciable amount equals $165,600, 80% of my purchase price. Right? And so what we do from that is we say we're going to multiply that or divide that by 27.5 so that we can divide it into little chunks, 27.5 chunks. And as we divide that out by 27.5, what it's going to say is we can write off, no questions asked, against this asset, $6,000 a year. All right? 1/27.5 of $165,000, the depreciable amount. Now, with that being the case, we can write off $6,000 a year. Now, if you know anything about taxes and taxation, you will realize that a $6,000 deduction only saves you $6,000 times your tax rate. All right? If you're at a 50% tax rate because you're earning good money and that's what you're taxed on the progressive tax table, well, then that's going to save you $3,000. If you're at the 25% tax rate, then that is going to save you $1,500. For our clients, we assume they're in the 25% tax rate, right? If you have no idea what I'm talking about, please go and watch my whiteboard video where I walk through tax rates and tax tables. I did one video on it. It did terribly because it turns out people don't want to hear about tax rates and tax tables, and that's the reason they're all going to get screwed on their taxes for freaking ever, and why Congress is going to be able to hide behind this garbage tax table forever, and why they're going to be able to have a tax code that's 4,000 pages. Sorry for the rant. Back to this. So that's the depreciable amount. When we talk to our clients, we say, hey, all this crap is going to filter out. And at the end of the day, we're going to assume our clients are probably in the 25% combined tax bracket, on the higher side, but not on the super, super higher side, maybe more, maybe less. Talk to your CPA. With that being the case, we're going to say there's about a $1,500 tax savings that's going to be built into this. Now, the nice thing is, $1,500 worth of value that I did not have divided into $54,000 worth of investment means just the tax savings is about 2.79%, almost 3%. Just in the tax savings. That's freaking amazing. I did better than a CD to bank just on the tax savings. That's freaking awesome. Sign me up. Why not? And it comes to everybody, and even the dumbest CPA in the world knows how to write off like the depreciation on a rental property. It's such an easy thing to claim, and it offsets $6,000 of the income of the property. And so we're really quite happy with that. Like tax saving, great. Sign me up. So with that being the case, you have your depreciation amount, and then you have your appreciation amount, and then you have your principal paydown. Now, principal paydown is something completely distinct. There is a big, long, complicated formula on how much of your principal is going to be paid every single year when you pay a 30-year fixed mortgage. I think in year one, it's like 1.48%. And then year two, it's like 1.52%. And then year three, it's like 1.58%. We have that formula in our spreadsheet, and it just kicks that out. And so what it's going to say right here for principal paydown is, hey, we know there's a 30-year fixed mortgage in this equation. We know the 1.48% or whatever that little percentage is going to work out to $2,600 of principal. So they took out a $150,000 mortgage. Year one, only $2,600 of that is going to be principal, right? Or year four in this case. Year four, there's going to be, that table will have graduated up, and it's going to be $2,600 worth of principal. Now, that's money I wouldn't have had. As long as the house doesn't go down in value, I'm eventually going to be able to cash out on that. And so with that being the case, cool. An extra $2,400. If I take $2,400 and then again divide it into my $54,000, this number is really important. Your total property investment, your TPI, that's what everything divides by. That's the denominator or numerator. Pretty sure the denominator is the one under the house. This is good examples that you don't have to be brilliant with math. You don't even have to have done all that well in math in school. I did okay. But when it's got a dollar sign, I got really interested. My dog is scratching, and you can probably hear that on the mic. Let's give this a hot second. Hey, Luna. What you doing? So cute. All right, so $2,600 divided into $54,000 is 4.86%. As soon as I buy a house mortgaged, I know I've got a 5% return coming in year four. That's about on par with any indexed fund out there, maybe a little lower than any indexed fund. But other indexed funds you're not being able to leverage to buy, again, unless you're buying on margin. And then you're a different class of investor and you've got all sorts of risk. Let's not get into that. If you're freaking out in the comments, stop. Stop freaking out in the comments. It's beneath you. With that being the case, you get a 5% return just because you pay down your principal. In 30 years, that whole thing's going to be paid off. That's awesome. So another 5% return. And then we get to the biggest piece of the puzzle. All right. Then we get to net operating income right here. And you can see, I'm going to tell the end from the beginning. This client earned $3,600 this year from owning this property. If we take that $3,600 and divide it out by the total property investment, we can see, voila, $54,000 divided by 3,600 is 6.71. This client earned 6.71% cash on cash, which is better than just about any mutual fund in the country, and 25% from appreciation, and 4% for principal paydown, and 2.79 for depreciation. You add all that up, and this client saw a total net benefit on their property in 1 year of about $18,000 off of a total property investment of $54,000. 39%. Suck on it, mutual funds. Suck on it, syndications. I know mutual funds and syndications may be able to put up decent returns, but they're not going to give you the leverage that real estate does. They're not going to give you the tax treatment that real estate does. Single family residential is going to give you far better control over your asset. They can control their mortgage. They can control their insurance when they buy it. They can control their exit when they sell it. They can control their financing. Do I want a HELOC? Do I want a second mortgage? Do I want to cash out refinance? Do I want to pay it off? They can control everything with single family residential, and they can earn 39% in a single year, right? That's disgustingly good returns. Now you might ask yourself, well, Jeremy, how much did the client pay you for a 39% return? And I will tell you, they paid me, and I'm not shy about this, $800. It was disgracefully low. They paid me so little. We had to raise our fees to $1,200. And so the truth is, they now pay us $1,200. But this client paid me $800 for doing this. And if I had not hit a 4% cash on cash return, let's say they had had a move out or something, Bedrock's contract, we offer this insane contract. It's like, if we can't get this number over 4% cash on cash, we will waive our fee entirely. We won't charge a penny. I'll do all the work. I'll pay my staff. We'll do everything that needs to be done. And we won't charge a penny for the year. We'll do all the work and pay it out of my own pocket. The reason I do that is because I realized that some of the firms that were offering this product, like a turnkey style single family residential, were having people invest in the middle of freaking nothing, in the middle of the freaking garbage, and buying garbage assets, what I call grenades, and they were sticking them with them. And I said, that can't be the way it is. Whoever helps you buy it has to be really concerned with it performing well, so they do their diligence well. And so we have a contract that says if you can't get to a 4% cash on cash return, that's principal paydown plus net operating income. If you can't get to a 4% cash on cash, we'll waive our fee. Now you might say to yourself, hey, Jeremy, this is already over 4%. Yeah, leveraged properties, a lot of that's coming in the principal pay down. Cash properties, it doesn't. But it's interesting because we say, hey, if we can't get to 4%, we'll waive our fee. We've got very, very happy clients when it comes to that. Even if you get an email from me that says, hey, we lost a tenant, we only got 2% this year, but that means we did our work for free. All the phone calls, all the data inputting, all the work, all the property management oversight, all the legal, all the compliance, all the bookkeeping, I paid for it out of my own pocket. You at least don't feel like I'm sending it down the river. All right, if you feel pain, I feel pain. That's been why the company has grown. So with that being the case, let's go down to the numbers. All right. This property in the beginning was renting for $1,720 a month. And then when we renewed the lease, it was super good demand. So it actually renewed with a new tenant at $1,870. And so we were able to see for the total year that the property brought in $29,000 of gross rent. That's a good property, good year. With that being the case, then we set to work on the fees. So the first things you're going to see is our admin fees. Okay, we charged this client $800. We got over 4%, so that was our fee for the entire year. $66 a month. It's now $100 a month. Inflation's been what it is. Legal and professional, setting up the LLC, keeping it in compliance, doing all the annual filings. That was $800. Mortgage payments on this property was $980.35 every single month. They sold the mortgage here to another provider, and so we had to wait for the new mortgage provider's data to come in. That's the thing that you're going to have to deal with. Almost every mortgage is packaged, bundled, and sold. And so even though we started with one mortgage company, they sold it and they said, hey, just so you know, after this date, you need to send your check to another company. And if you send it to the first company, they don't process it and then you get behind on your mortgage. So we just had to wait for a month and be like, okay, where's the mortgage? Who is the mortgage with? And that screwed with 2 mortgage payments. If you're the owner of the property, you're going to have to deal with that. No property manager in the world is going to keep track of who owns your mortgage. And we call every single new mortgage provider and say, hey, are you the new mortgage provider? And they're like, yeah, we bought it for this much. And then we call the old mortgage provider and we say, hey, did you sell this mortgage provider? Because there's a little thing in our world called mortgage fraud. And lots of times you get a random letter out of the blue that says, hey, send us your $980 a month from now on. And then 4 or 5 months later, the original mortgage provider calls and says, hey, why aren't you sending us those checks anymore? And you say, well, I got a letter from some random guy, Billy's bank, and he said he bought my mortgage. And they're like, he didn't buy your mortgage. And you realize you just sent Billy $4,000. Good luck getting that back. And so you got to call your mortgage provider and make sure they actually did sell your mortgage and make sure you have the right numbers and make sure it's going into the right account. Again, all things your property manager won't do. He is not going to manage your mortgage, and your mortgage is going to get sold. We have had some properties that have had their mortgage sold 4 times in 7 years. All right? It happens. Business management. It's the crap that you have to do that your property manager won't ever do. So anyone who says your property manager will take care of everything, bull freaking crap. They've either never done it or they're trying to sell you something that is an untruth. I'm just calling it like it is. It is an untruth. So with that being the case, next thing we have pest control. Memphis, Tennessee, very buggy city. We pay $80 a quarter. That's nice and normal. Property management fees. Our property manager charges us 8%. And then I think it's 50% of the lease when they sign the first lease, and I think it's like $200 to renew a lease. I don't know that off the top of my head. My team does. So with that being the case, there's the property management fees. As you notice, those fees kind of stretch out when we change the mortgage around. They were getting rent all the time. You'll notice that the amount of the fees increased when the rent increased. When we change that rent over. That's fine. With that being the case, pretty typical stuff. Repairs and maintenance, there's always something. We reserve for repairs and maintenance between 10 and 20% of gross revenue per year. On this house, we did $21.9 thousand. I would be expecting to spend between $2,000 and $4,000 for vacancies and repairs. As you can see right here, we spent about $2,000. About $2,000, right on the lower end, but there's always going to be something. There's always going to be some repair happening. Anyone who's like, nah, you just buy it, it's totally 100% done, you'll not have to put any more money into it. Bull freaking crap. And that is the reason that we require all of our clients to put between $5,000 and $10,000 into their LLC account so that they can have money sitting there to pay for those bills and it doesn't affect the overall property. Also, so we don't have to call them a million times, go back and forth a million times and be like, hey, we need money, we need money, we need money. You know what relationship sucks? The relationship where you have a guy saying, hey, I need money, I need money, I need money all the time. Bedrock doesn't want to be that guy. We're going to put that money aside up front. We're going to plan for it up front, and then we're just going to let it ride, and we're going to have enough vacancy repair reserves to handle it. And if we don't, we're going to chat with you and say, hey, if there's not enough for this or that reason. Luckily, we very rarely have to have that conversation. But that's the way you do it when you're running it like a professional. Now, with all that being the case, you can see all of those expenses coming out. On a typical month of $1,700 of rent, we lose money. We have $600 left over. $1,700 comes in, we pay. We have $600 left over. $700, $1,800, $300, negative $300, $700, $700. At the end of the day, we had $1,400 left over. All said and done, after all the expenses. Now, that's actually not the case because I'm not far enough over to the right. At the end of the day, we had $3,600 left over. We brought in $21,000. We paid bills, more bills. Mortgage is the lion's share of that. And we ended up with $3,600 left over. We take that $3,600 down here. Do we send money to the owner? Do we not send money to the owner? Do we send the money to the owner monthly or quarterly? Do they live on the money? All of that's different for every single client. It looks like this client had a monthly draw of a certain amount, so they were getting about $2,000 a year just to live on. All right, we're happy to set that up. That's one of the things Bedrock oversees. We need to keep that on your balance sheet because when tax time comes, you need to know what to get taxed as an individual and what to get taxed of in the LLC, or at least how to present that data to your accountant. Again, no property manager's ever going to do this. No property manager's ever going to be like, hey, you took $2,000 of distributions, you need to present that to your accountant this way. You're going to have to do this stuff. And beyond all that, data sources massively change. This piece of data right here is going to come across in property management reports, or it's going to come from your bank account. Now, if it comes from your bank account and you didn't set up an LLC, it's just going to come from your personal bank account, and you're going to have to go and pull all your real estate expenses and give them to your accountant piece by piece. And if the rent changed in the middle of the year, you might have to figure out where that is, unless it's all by the same property manager. But if your property manager changed in the middle of the year, you're going to have to remember, oh yeah, this was property manager 1 who kind of sucked, and then I changed my property manager to property manager 2. And if I've got 60 properties, that's going to become a living hideousness without end. Now, most people are just going to take their property manager statements, which is just a PDF that your property manager sends you once a month, and they're going to give those to their CPA. And their CPA is going to go through, and they're going to enter some of this data. Now, the CPA is going to charge you $100 an hour if their assistant's doing it, or $150 an hour if they're doing it. So we can become really cost ineffective by having your CPA doing data entry on your properties, especially if you have 60 properties, especially if each property is in its own LLC, or multiple properties are in single LLCs, and those LLCs have to have different schedules done. Your property manager is not going to do any of this, all right? You're going to have to do this. You're going to have to keep your numbers straight, and you're going to have to give them to your CPA, all right? Bedrock does all this crap. Like, people are like, hey, what do you do? I'm like, I do all this crap that most people don't even talk about. Most people are like, hey, just hire a property manager to take care of everything. And I'm here being like, that's not true. What is everything precisely? Does that include, like, manually typing in numbers from a PDF because it comes from a property management software that does not have direct integration, what are called APIs, into QuickBooks? Does that mean manually typing in your own stuff into Quicken? Are they handling everything as a property manager sitting back there? Because there's some data that the property manager doesn't even have access to. All right? They have access to the rent. That comes off the property manager statement. All right? So we're going to say rent. That comes off the property manager statement. Okay? The mortgage payments, that comes out of the bank account. All right? No property manager is sitting there writing a check and signing it in your name to pay the bank account. No property manager is going through when a mortgage is getting sold. No property manager is calling the old mortgage company, making sure they did actually sell it. No property manager is calling the new mortgage company, making sure they did buy it. No property manager is making sure that they got the first payment and that it didn't go to some weird suspense or holding account. No property manager is doing any of that. Ownership has to do all that. Just hire a property manager. They'll take care of everything. Oh, except for the data entry when it comes to tax prep, and except the taking care of paying my mortgage and making sure I'm not getting swindled for mortgage fraud. Besides those things, I guess they'll take care of everything. Bull crap. Bull crap. It's just not the case. Okay, pest control. Property manager does that, and that comes through on the property management statement. All right? But a lot of times we'll have a pest control contract for quarterly, and then all of a sudden we'll see 2 or 3 treatments all happen at the same time because the pest control overbilled us, or the pest control is on auto bill and sold to some other company. We gotta be like, why are we getting charged quarterly every single day for a month? Like, what is happening here? And so we got to call the pest control company or call the property manager who holds the pest control contract and say, hey, pest control company's charging us all over. And they're like, hey, let me reach out to them. So they call and talk to pest control, and then you got to follow up in 3 weeks and be like, hey, my dude, I never got an answer. Oh yeah, they told me they actually misbilled you. They were going to give you your money back weeks ago. And I'm like, I haven't seen that money back. And the property manager's like, I'll call them again. So they call the pest control company again, and then the pest control company eventually gives you your money back. No property manager is going to do that. They're not going to keep themselves honest. Like, they're going to maybe call the pest control company. They're not going to have a flag in their systems to make sure the property manager actually did what they said they were going to do. We love property managers as long as they're watched like a rat in a cage. So the truth is, you've got to understand these things. The property manager will just handle everything. No, they won't. No, they won't. They won't make sure they're doing a good job. They won't make sure they follow through on a task. You're going to have to do this. That's what this shows more than anything. There is a portion of single-family residential investing. There's a portion of investing that the property manager's not going to do. You're going to have to do it. It is kind of like buying a job. Now, it's a perfectly reasonable job, and it's very passive, and it can be very passive, and it can be very lucrative, and I really like it, and I've made a career of it. In all candor, this company is my first company I've ever built that's worth millions because it deals with all of these problems. And in all candor, we charge about $100 a month to take care of everything else, right? And if we don't get to 4% cash on cash, we're willing to waive our fee. Just depends on how much risk you want us to take. So with that being the case, you can just see here, okay, property management fees, cool. Are those legit? Hey, why'd they go up? The property manager's going to look over their bills and be like, why did they go up? Oh, because they raised the rents here. That's why they went up. Cool. I'm fine with that. Sometimes we see property management fees just flip out like their software goes rogue. We got a 1099 with misstated income. You got to call your property manager. Hey, your 1099 says I earned $3,000 more than I actually earned. Oh, my CPA must have mistyped that. Well, I'm going to pay taxes on $3,000 more than I actually got paid. Back and forth. Open a ticket. Follow up with your property manager. Make sure it gets resolved. Business management. All business management. All right. And so with that being the case, then we have net operating income, and then we have all other distributions. How much money do I want out of my LLC? How much money needs to stay in my LLC? How much money needs to be there for reserves? All of that stuff has to be done. Property manager doesn't do any of that stuff, right? Like any of that stuff. Hey, are these repairs that were done legitimate? Did they get done? Do they have final pictures? Did the property manager say, hey, we're going to replace a door? Cool. Is that a reasonable price for replacing a door? Or am I getting totally hosed? Are they soaking me for fees? Does the property manager contract say that they're going to charge me 50% extra for any work or only on orders over $1,500? All of this stuff has to be accounted for. It has to be accounted for. It's all work that lands on ownership. Or Bedrock's happy to do it for $100 a month. We're happy to be the experts in the room that says, hey, that door is insanely priced. What is up with that? That's an insane price for a door. Oh, well, we had a guy come out. He only does this. He doesn't really do doors. Okay, have a door guy do it. Like, what are you talking about? Keeping your property manager honest, that is part of ownership. And so with that being the case, part of what Bedrock does is we get all of this information from different sources. Property management, the bank, different statements, all this stuff. We do all of this behind the scenes work that most people just aren't even honest about. They're like, oh yeah, property managers will take care of everything. Bull freaking crap. Bull freaking crap. I do not buy it, not for 1 second. And that's just because I've happened to do this for thousands of properties over the years. And it's just not that straightforward. There's stuff that has to be done that lands on ownership on a single family residential. So with that being the case, we have this beautiful report that we provide every client every single year. On this property, we got 39.42% ROI. Freaking awesome. Freaking awesome. But then we go one step beyond that because we have data, and I love data. I love interesting data because with data you can do interesting things. For example, this whole time I have been showing you this screen. There's been this PDF right here, and then there's been another one right here. The reason for that is because we have enough data and enough competence that early on in the days of Bedrock, I said, I want a window. I want you to design me a window in this program. Because this whole conversation is assuming that I have a leveraged property, that I spent $50,000, $4,000 on this property, right? Well, what if I would have bought the property cash? What would have changed? I love this stuff, guys. Like, I live for this stuff. I live for the building and the systems and the client interface and getting my clients smoking returns on this. I love this stuff. How could we do the same thing if we bought it cash? So what we do for every single client every single year is we develop a alternative report, which is the exact same with 2 changes, right? Number 1, it doesn't have the picture, so I can tell them apart at a glance. And number 2, we assume that we didn't buy the property for $50,000 cash, that it's the exact same property. So this is the same exact report as this, right? 39% ROI. This one says 12.5% ROI. They're the same property in all respects. The fundamental difference between these 2 properties, and the really important thing to understand is if you're getting into real estate, is that cash properties are always going to have a different risk position. They're going to have a different return position. They're going to act very differently, right? Because in this example, we invested $223,000 to get the property. Now you might be like, but Jeremy, earlier you said the whole property was $207,000. How would you spend $223,000? Because there are costs when acquiring properties. If you haven't watched the Real Estate is a Terrible Short-Term Investment video, it's a video a lot like this where I walk through, hey, here's the closing costs, here's our fees, here's realtor fees, here's stamps in different municipalities. There's all sorts of crap that people just throw on. Closing fees with the closing attorney, 1031 exchange custodian costs. There's just a bunch of crap that gets kind of wedged in at the last minute in real estate transactions. We can talk about whether that's good or bad, but it is, right? So with that being the case, people pay Bedrock a fee to help us navigate those waters because they can become very nebulous waters. And it's like, well, I don't want to deal with all the back and forth and all this crap, and I don't know what's a good deal and what's not a good deal. That's why people pay us to help them buy a house. Our teams help people buy like 5,000 houses. So with that being the case, you take the same exact math, $21,009 of rent. You take the same exact expense stack from the same exact positions. You look at every single piece of this and you say, hey, if the only thing that I changed was there was no mortgage, I just subtracted out that $900.80 a month, what would have changed? Well, I would not have had principal pay down because I don't have a mortgage. So that entire piece of this equation just goes away, right? I wouldn't have had a mortgage, and so if we go down to the bottom of the page and just look at that bottom, we have the same income stack, but we don't have that $11,000, and so our income at the end of the day is going to bump by 11 grand. We're going to end up with a total net operating income of 15.3. That's going to be what we hold on to. And a couple of the other numbers change a little bit, but they have 15.3 of passive income coming in. That's 7%. That's just like an index fund. That's just like the stock market, except this one also went up in value. We still had a property we bought for $207,000 over the last 4 years, gone to $263,000, right? We still had $13,000 of appreciation. None of those numbers change based on, do I have this thing paid off or not? But I have to divide that $13,000 into $223,000. Almost nothing changed. The thing is, our return on investment was a lot less because our investment was a lot more. That's the fundamental difference between cash real estate and leverage real estate. The investment is a lot more in cash real estate. There are clients every single year who we say, hey, who would you rather be going forward? Would you rather go forward with the leveraged property, or would you rather go forward with the cash property? And when you put it side by side like this, our clients have the best visibility in the industry, I think. I don't know anyone who does this for clients besides us. It's easy to say, and I'm sure some people are typing it in already. Hey, why would you ever want a 12% return when you could have a 39% return? My happiest clients are getting the 12.5% return. Okay? They've got a property, cash. It's out earning the S&P 500. still appreciating well, they're still getting tax benefits, they don't ever have to worry about a mortgage. They don't ever have to worry about a tenant moving out in the middle of the night and them getting stuck with a couple months of mortgage payments. The mortgage here is, I don't know, $980. One tenant moving out is going to eat that thing down to zero, maybe even negative. If it eats it negative enough, the total cash on cash is going to drop below 4%, and I'm going to waive my fee. A tenant moves out, does damage to a property. It might take this thing negative for a year. I've got a $15,000 buffer before I go negative on a cash piece of real estate. I have conversations all the time with my clients where I say, it may be the point in your life where you want to pay this thing off. You'll have less of a ROI, but you'll have more peace at night, right? You'll have $15,000 a month coming in for the rest of it. All right. If it has problems, it won't ever threaten foreclosure. Now, we've never lost a property in foreclosure in the history of Bedrock. Never happened. I don't think it would ever happen. The reserves that we carry really protect us. But the truth is, it's not that one of these returns is better for another. I think this return is better if you're young and if you can accept some risk in your portfolio. I think this return is better if you're old and you just want to live off the money and not worry so much. I don't see anyone else even making this effort to give people math like this, where they have two completely different returns every single year on every single property, bringing all the data together into one concise place. I had a client the other day say, I just want the report. How much do I have to pay you for the report? But because if I don't manage the bank account, I can't get the bank account's level data. If I don't manage the property management relationship, I can't really attest to these numbers, right? If we're not doing it all along the way, I can't have my bookkeepers enter numbers manually when the property manager software doesn't API with the QuickBooks or with the Quicken. There's so many things along the way that we're doing that it's just a cost-ineffective process to try to produce this report. Now, the truth is, I'll happily produce it for you. If you want me and my team to go through your books and you have 12 months of property management statements and you can isolate your expenses specifically for this and you get us to do it one time, I will charge $800. I'm thinking this off the top. You hand us all your stuff in one nice little deep pile, and my people say, hey, that is totally accurate. We'll go ahead and put that into a report. $800 is how much we would charge to go through and get a report like this ready. Or our fee is $1,200. Because if we do the rest of the work also, it doesn't take us a lot more time to generate a report. So, with that being the case, my new price for a report like this is $1,000. I'm going to go ahead and I'm going to shoot high. Let's say it's $1,000. I don't even want to do this report. I don't want that to become a part of our business, but if it does become a part of our business, $1,000 is how much I would charge to do a report like that. And that is assuming someone can submit their crap super clean to us, which I know they can't. I don't even want to do that report. $1,000 if they can submit their stuff clean to us, and if we do not have to go back and argue with their property manager, we just have to get the data into a tax-ready place. And to be honest, that's about what you're going to pay for your accountant to do the work anyways. There's huge benefit from using a company that does this hundreds of times a year. I love what we do. I love what we do. This is just one little glimpse of what I love doing for a living. It's helping people have really good decision-making data on their assets, helping people earn really good assets, a 39% return. Freaking A. Killing it. Killing it in single-family residential. Really enjoying the product, really enjoying the process. If you ever want to have a conversation where you can get a piece of rental property, and if you're starting to understand what Bedrock does and want to have a conversation, feel free to give us a call. I have a number somewhere. I'm going to count on Ellen to put it up on the screen. 801-255-0055. If you're interested in another video like this, where we just talk through the nuance, I would actually go watch an interview that I did recently with Spencer Sutton over at Evernest. Their property management firm manages 24,000 doors. The hidden lies behind passive real estate. I think it goes in way more, and you get the other side of the equation. You get the property manager side of the equation when we're saying, hey, these are real risks. They're real work that has to be done. And then a property manager with 24,000 doors has the opportunity to say, hey, Jeremy, you're full of absolute crap. If you want to see that video, the hidden lies behind passive real estate, click on that. I'll put it right here. Love you guys. Bye-bye.